Okay, the price action studies I am doing right now. So there is a concept in that where you can the one that we basically use the accord and discord between the indices, all right. But since the price action studies they follow the price chart only, right, and we are looking at market profile chart, they have a little bit of a traditional way of finding out whether the two indices are diverging or not. So they gave this method, right. It's a very simple method to just like we plot divergence on an RSI chart or some other chart, right. So you can see here yesterday Jan 24, right. So what happens, we make this high and then we make a higher high, right, here just before close, and then today market is going low. So if you look at this and you mark the corresponding highs, you will see that this was that previous high, and just before close we made a lower high. So if this is happening, what it means is that Nifty made a higher high, right, and Bank Nifty in the same period made a lower high. So it was like this is a divergence. Now this what kind of divergence is this? It really does not matter. What it means is that Nifty is stronger whereas Bank Nifty is weaker. Make sense? Now how can we use this? You have to look at overall market conditions or context in this case. Now in our case the context is bearish. Make sense? So if the context is bearish, you select the weaker of the two, in this case Bank Nifty, and if you have to take a short, you take a short on weaker index. Make sense? So if the overall context was not bearish, it was bullish, then we knew that Nifty is stronger than Bank Nifty. It makes sense to look to trade Nifty. And obviously in that case, probably, this sort of scenario might happen where Bank Nifty makes a lower low, but Nifty refuses to make a lower low. And this could be your point to go long. Make sense? So don't overdo it. Don't overdo it. But just a development that I learned about something, so I thought about sharing it, and this basically goes along with our idea of accord and discord between indices, and you can very well use this in your trading. All right, so just something, if you want to use it, you can use it, but again the same request is not to overdo it, not to think that okay, this is some holy grail and every time there is a divergence market is going to tank or market is going to rally. It's not like that. You have to look at the overall conditions, but you can select which index to trade. Many people trade both Nifty and Bank Nifty, but they cannot make out which index to trade or which index is weaker, right? So let's say overall context is bearish, market is likely to go higher, but Nifty is looking stronger and Bank Nifty is looking weaker, then you trade Bank Nifty and Bank Nifty is likely to pull Nifty down. So these kinds of correlations you can make and trade according to them.